There is a signal forming in the precious metals market right now that most investors are completely ignoring. It is not a headline. It is not a tweet from a celebrity fund manager. It is not a prediction from a newsletter salesman. It is a ratio, a simple mathematical relationship between two assets that have served as money for thousands of years. And this ratio is beginning to move in a direction that, if it continues, will represent one of the most significant shifts in monetary metal valuations that we have seen in over a century. I am talking about the gold to silver ratio. For those unfamiliar, this ratio simply tells us how many ounces of silver it takes to purchase 1 ounce of gold. If gold is trading at $2,000 per ounce and silver is trading at $25 per ounce, the ratio sits at 80 to 1. 80 ounces of silver for 1 ounce of gold. Now here is what makes this particular moment so unusual. Throughout most of recorded monetary history, this ratio has averaged somewhere between 12 to 1 and 16 to 1. For thousands of years, across different civilizations, different empires, different monetary systems, that relationship held relatively steady. Yet, in our modern era, the ratio has stretched to extremes that would have seemed incomprehensible to our ancestors. We have seen it reach 100 to 1. We have seen it stay elevated at 60, 70, 80 to 1 for extended periods. And now, there's a growing contingent of serious analysts, monetary historians, and institutional observers who believe this ratio is not simply going to mean revert. They believe it is going to overcorrect. They believe we may be heading toward a ratio that has not been seen in modern markets, 7 to 1. Let me be very clear from the outset. I'm not here to tell you this will definitely happen. I'm not here to promise you wealth if you position yourself correctly. Markets are uncertain. The future is unknowable. Anyone who tells you otherwise is selling something other than wisdom. What I am here to do is walk you through the evidence, explain why intelligent people are taking this possibility seriously, help you understand what forces could drive such a dramatic repricing, and most importantly, help you think clearly about how to approach the situation regardless of which direction the market ultimately moves. This is going to require patience. It is going to require that we think in longer time frames than most market participants are comfortable with. And it is going to require that we set aside both the euphoric predictions and the dismissive skepticism that dominate most financial commentary. Are you ready? Let us begin. Before we can discuss where the gold to silver ratio might be going, we need to understand what it actually represents and why it has moved the way it has throughout history. This ratio is not arbitrary. It reflects something real about these two metals and their relationship to human civilization. Gold and silver emerge from the earth in a relatively fixed geological ratio. Estimates vary, but most geologists suggest that silver is approximately 8 to 17 times more abundant than gold in the earth's crust. This natural scarcity ratio provided the foundation for how ancient civilizations valued these metals relative to each other. When the Roman Empire established its monetary system, the ratio hovered around 12 to 1. When Spain was flooding Europe with New World silver in the 16th century, the ratio fluctuated, but generally stayed within a band of 10 to 15 to 1. When the United States established its monetary system in 1792, Congress set the official ratio at 15 to 1. This was not coincidence. This was not manipulation. This was a reflection of the relative scarcity, the relative difficulty of extraction, and the relative usefulness of these two metals across thousands of years of human economic activity. So what happened? Why did the ratio explode to levels that our ancestors would have found absurd? The answer lies in the demonetization of silver. Throughout the late 19th and early 20th centuries, nation after nation abandoned silver as money. They moved to gold standards, and eventually they abandoned gold standards as well in favor of purely fiat currencies backed by nothing but government decree. When silver lost its official monetary role, it became primarily an industrial metal. Yes, people still bought silver coins and bars. Yes, silver retained some monetary premium in the minds of certain investors, but the primary driver of silver demand shifted from monetary use to industrial use. Gold, by contrast, retained much more of its monetary character. Central banks continued to hold gold reserves. Wealthy individuals continued to view gold as the ultimate store of value. The investment demand for gold remained robust, even as its official monetary role diminished. This divergence in how the market perceived these two metals explains much of why the ratio expanded so dramatically. Gold kept its monetary premium. Silver lost most of its monetary premium and had to compete on industrial merit alone. But here's the question that thoughtful observers are now asking. What if that is changing? What if we are entering an environment where silver's monetary premium is being rediscovered? What if the industrial demand for silver is set to explode at precisely the same moment that investment demand is accelerating? What if the supply situation for silver is far more constrained than most investors realize? These are the questions driving the thesis that the gold to silver ratio could compress dramatically. not to 16 to 1, which would merely be a mean reversion, but potentially to levels below the long-term historical average, potentially to single digits. Let us examine each of these factors in turn. To understand why some analysts believe silver is poised for a dramatic repricing, we need to start with supply. Here is a fact that surprises most investors when they first hear it. The vast majority of silver produced each year does not come from primary silver mines. It comes as a byproduct of mining other metals, primarily copper, lead, and zinc. Think about what this means. Silver production is not primarily driven by silver prices. It is driven by copper prices, by zinc prices, by the economics of base metal mining. If silver prices double, that does not necessarily mean silver production will increase proportionally. The miners are not digging for silver, they are digging for copper, and silver happens to come along for the ride. This creates a structural constraint on supply that does not exist for gold. If gold prices rise substantially, gold miners can increase production, reopen marginal mines, invest in new exploration. The supply response to higher prices is relatively elastic. For silver, the supply response is muted. You cannot dramatically increase silver production without dramatically increasing base metal production, and base metal production is governed by its own economic logic. Now, layer on top of this the fact that silver, unlike gold, is consumed. Most gold ever mined still exists in some form. It sits in vaults, in jewelry, in coins, and bars. Gold is recycled at high rates because it retains such high value in such small quantities. Silver is different. Silver is used in electronics, in solar panels, in medical devices, in countless industrial applications, where it is dispersed in tiny quantities that make recycling economically unfeasible. Much of the silver mined throughout history has been effectively lost, scattered in landfills and electronic waste and industrial applications around the globe. This means that the above-ground stockpiles of silver, relative to annual production, are much smaller than most people assume. The silver that exists and is available for investment is far more constrained than the headline numbers might suggest. And now we need to talk about what is happening on the demand side. Silver sits at the intersection of two powerful demand forces that are both accelerating simultaneously. The first is investment demand. We are living through a period of unprecedented monetary expansion, fiscal deficits, and institutional loss of confidence in fiat currencies. Central banks around the world have printed trillions of dollars, euros, yen, and yuan. Government debt levels in most developed nations have reached levels that would have been considered crisis-worthy just 2 decades ago. In this environment, hard assets are being reassessed. Gold has already begun to respond, with central banks around the world increasing their gold reserves at the fastest pace in decades. But silver, which has historically moved in sympathy with gold during periods of monetary concern, has been slower to respond. This lag is what some analysts see as an opportunity. If silver is eventually re-rated as a monetary metal, as a form of gold for the common person, the percentage gains could substantially exceed those of gold itself. But the investment thesis is only half the story. The other half is industrial demand, and here the picture is becoming increasingly compelling. Silver is essential for the green energy transition. Solar panels require silver. Electric vehicles use more silver than conventional vehicles. The electrification of everything, from transportation to buildings to industrial processes, requires vast quantities of silver for electrical contacts, conductors, and connections. The projections for silver demand from the solar industry alone are staggering. As nations around the world race to build out solar capacity, they are competing for a finite supply of silver. And unlike other metals that might be substituted in various applications, silver's unique properties make it difficult or impossible to replace in many critical uses. Then there is the emerging demand from medical applications, from electronics, from the continued growth of consumer devices and industrial automation. Each smartphone, each computer, each sophisticated piece of equipment contains small amounts of silver that add up to enormous aggregate demand. When you combine accelerating investment demand with accelerating industrial demand, and you set this against a supply picture that is structurally constrained, you begin to understand why some observers believe we are heading toward a period of significant silver repricing. But there's another factor we need to discuss, one that most financial commentators overlook because it requires thinking about history and market psychology rather than simply crunching numbers. Markets do not move in straight lines. They do not mean revert in orderly, predictable fashion. They overshoot. They overcorrect. They are driven by human emotion, by fear and greed, by herding behavior and momentum. When the gold to silver ratio compressed in previous historical episodes, it did not simply drift back toward the long-term average. It crashed through it. In 1980, during the Hunt Brothers episode and the broader precious metals mania, the ratio compressed to approximately 14 to 1. Now, you can argue that this was driven by manipulation, by artificial forces that should be disregarded, and there is merit to that argument. But consider the underlying psychology. When investors collectively decide that silver is undervalued relative to gold, they do not stop buying when fair value is reached. They do not say, the ratio is now at 16 to 1, which matches the historical average, so I should stop buying silver and start buying gold. Instead, momentum takes over. New buyers pile in because the price is rising. Existing holders become reluctant to sell because they believe further gains are coming. The feedback loop intensifies until it reaches an extreme that seems irrational in retrospect. This is not a flaw in market function. This is how markets function. Prices do not stay at equilibrium. They oscillate around equilibrium, swinging from undervaluation to overvaluation and back again. If you accept this premise, then the question becomes not whether the gold to silver ratio will mean revert, but how far beyond mean reversion it might travel. The analysts projecting a ratio of 7 to 1 are not necessarily predicting where the ratio will settle permanently. They are projecting where it might go during a period of maximum dislocation when momentum is strongest and sentiment most extreme. Is this guaranteed to happen? Absolutely not. Markets are not governed by deterministic laws. The ratio could remain elevated for years. It could compress modestly and then expand again. There are no certainties in investing. But understanding that markets overshoot helps us think clearly about the range of possible outcomes. It helps us prepare mentally for scenarios that might seem extreme, but are well within the range of historical precedent. No asset trades in isolation. To understand where precious metals might be heading, we need to zoom out and consider the broader economic and monetary environment. We are living through a period of transition. The monetary order that has prevailed since 1971, when the last link between gold and the dollar was severed, is showing signs of strain. This does not mean it will collapse tomorrow. Systems can persist for decades in weakened states, but the pressures are building. Debt levels across the developed world have reached levels that historical precedent suggests are unsustainable. The United States, the issuer of the world's reserve currency, is running fiscal deficits that would have been considered emergency wartime measures just a generation ago, and these deficits are occurring during periods of relative peace and economic expansion, not crisis. The response to these debt levels has been and will likely continue to be monetary accommodation. Interest rates suppressed below the natural market rate. Central bank balance sheets expanded to absorb government debt that private markets are unwilling to hold at current prices. In this environment, hard assets tend to appreciate. Not necessarily quickly, not necessarily in a straight line, but persistently as the purchasing power of fiat currencies erodes. Gold has been responding to these forces. Central banks, particularly those outside the Western monetary system, have been accumulating gold reserves at an accelerating pace. China, Russia, India, and numerous other nations have been reducing their exposure to dollar-denominated assets and increasing their holdings of physical gold. This is not speculation. This is documented fact. Central bank gold purchases have reached multi-decade highs. Silver, by contrast, is not held by central banks in any meaningful quantity. There is no official sector demand providing a floor under the price. This might seem like a disadvantage, but it also means that silver has further to travel in terms of institutional adoption. If even a small fraction of institutional capital decides that silver deserves a place in portfolios, the impact on a relatively small market could be substantial. The silver market is tiny compared to gold, which is tiny compared to bonds, which is tiny compared to global real estate. Small shifts in allocation can have outsized effects. History does not repeat, but it often rhymes. There are periods in the past that share characteristics with our current moment, and studying them can provide useful perspective. Consider the late 1970s. The United States was dealing with the aftermath of abandoning the gold standard. Inflation was accelerating. Confidence in monetary institutions was waning. The fiscal position of the government was deteriorating. During this period, precious metals underwent a massive revaluation. Gold rose from around $35 per ounce to over $800 per ounce at the peak. Silver rose from around $2 per ounce to nearly $50 per ounce. The gold to silver ratio compressed dramatically as both metals were reassessed as alternatives to depreciating paper currency. Then consider the period from 2008 to 2011. Following the financial crisis, central banks around the world embarked on unprecedented monetary expansion. Quantitative easing, zero interest rate policies, emergency lending facilities. The monetary base exploded. Precious metals responded. Gold rose from around $700 per ounce to over $1,900 per ounce. Silver rose from around $9 per ounce to nearly $50 per ounce. The gold to silver ratio compressed from nearly 80 to 1 down to around 32 to 1. In both cases, the ratio compression was not orderly. It was violent. It happened faster than most observers expected, and it was driven by a combination of monetary concerns and momentum-based buying. Are we in a similar period today? The parallels are certainly present. Monetary expansion, fiscal deficits, geopolitical uncertainty, loss of confidence in traditional institutions. But the differences are also important to acknowledge. The starting point for the ratio is different. The supply and demand fundamentals are different. The composition of market participants is different. History provides context, not certainty. It tells us what is possible, not what is inevitable. Let us now shift from analysis to action. If you already own silver or other precious metals, how should you think about your position in light of this analysis? The first principle is patience. If the thesis outlined in this video proves correct, it will not play out overnight. Market cycles unfold over years, sometimes decades. The move from an elevated gold to silver ratio to a compressed ratio could take 2 years or 10 years or longer. No one knows the timeline with precision. This means that your holding period matters enormously. If you are positioned with capital you need for near-term expenses, you are vulnerable. A position that will ultimately prove profitable can cause immense psychological and financial damage if you are forced to sell at an inopportune moment. Review your allocation with clear eyes. Ensure that your precious metals holdings represent capital you truly do not need for years. If not, consider whether some adjustment is warranted regardless of your long-term views. The second principle is right-sizing. There is a temptation, when you become convinced of a thesis, to concentrate your portfolio heavily in that thesis. This is almost always a mistake. Even if you are correct about the direction, you can be wrong about the magnitude, the timing, or the path the market takes to get there. Diversification is not an admission that you lack conviction, it is a recognition that you lack certainty. And in markets, certainty is a luxury that no one actually possesses. Ask yourself honestly whether your precious metals allocation, particularly your silver allocation, represents a reasonable percentage of your total wealth. Different people will have different answers based on their circumstances, their risk tolerance, and their other holdings. But whatever your answer, make sure it is a deliberate choice rather than a position that grew through inattention. The third principle is emotional preparation. If silver does undergo a significant repricing, the journey will not be comfortable. There will be drawdowns. There will be periods where the price declines and the financial media declares the trade dead. There will be moments of peak pessimism that test your conviction. Prepare yourself mentally for this now, while you are thinking clearly, rather than waiting until you are in the emotional crucible of a market decline. Write down why you own what you own. Write down what would have to change for you to alter your position. Consult these notes when the market is testing you. The final principle for existing holders is this: avoid becoming emotionally attached to your position. It is possible to be correct about the fundamental thesis and still mismanage the position badly. Taking some profits during moments of strength is not a betrayal of your convictions. It is prudent risk management. The goal is not to be right. The goal is to grow and preserve your wealth over time. If you are not currently holding precious metals but find this analysis compelling, how should you approach building a position? The first principle is gradual entry. The urge to establish a full position immediately after becoming convinced of an idea is almost universal and almost always counterproductive. Markets do not care about your conviction. They will do what they will do, regardless of when you decide to participate. Gradual entry, sometimes called dollar-cost averaging, allows you to build a position over time while reducing the impact of short-term volatility on your average cost basis. It also provides psychological benefits, as you become accustomed to watching the price fluctuate before your full capital is at risk. Consider spreading your intended purchase over months rather than weeks. There is rarely a need to rush in markets. The opportunity, if it exists, will persist long enough for patient capital to participate. The second principle is understanding what you own. Precious metals can be owned in many forms: physical coins and bars, exchange-traded funds backed by metal, mining company stocks, futures contracts. Each form carries different risks and benefits that you need to understand before committing capital. Physical metal eliminates counterparty risk but creates storage and insurance considerations. ETFs provide convenience but introduce counterparty risk and potential tracking error. Mining stocks offer leverage to metal prices but add company-specific risks. Futures provide maximum capital efficiency but require sophisticated risk management and carry the risk of total loss. There is no single correct answer for everyone, but there is a correct answer for you based on your circumstances, your expertise, and your objectives. Take the time to understand the options before committing. The third principle is integration. Your precious metals position should not exist in isolation. It should fit within a broader financial plan that accounts for your income, your expenses, your other investments, your insurance, your estate planning, and your life goals. If you do not have a broader plan, building one should be a higher priority than adding precious metals exposure. The foundation matters more than any single investment. The fourth principle is humility. The thesis presented in this video might be wrong. The gold to silver ratio might stay elevated for another decade. It might expand further before it contracts. Silver might underperform gold, might underperform equities, might underperform real estate. No one has a monopoly on truth about the future. Allocate accordingly. Build a position that you can live with if the thesis proves incorrect. If you would be devastated by a 50% decline in silver that persisted for years, you are probably considering an allocation that is too aggressive for your circumstances. Let us now address directly the behavioral errors that destroy returns in markets like these. These warnings apply whether you are an existing holder or a potential investor. The first mistake is emotional trading. When silver drops 15% in a week, as it has done multiple times in recent decades, the temptation to sell is overwhelming. When silver rises 30% in a month, the temptation to buy more is equally powerful. Both impulses typically lead to poor outcomes. Emotional trading causes investors to buy high and sell low, the exact opposite of profitable behavior. The solution is to make your decisions when you are calm and then execute them mechanically, regardless of how you feel in the moment. If you find yourself unable to do this, if you consistently override your planned strategy based on short-term market movements, you need to either develop better emotional discipline or remove yourself from active decision-making by using automated systems or delegating to professionals. The second mistake is over-leveraging. Leverage amplifies returns in both directions. If you use margin or futures to increase your exposure and you are right, you make more money. If you are wrong, or if you are right, but the market moves against you temporarily before moving in your favor, you can be wiped out. The history of precious metals investing is littered with people who were correct about the direction but destroyed by the path. They used leverage, suffered a drawdown, received a margin call, and were forced to liquidate at the worst possible moment. Unless you are a professional with sophisticated risk management systems, avoid leverage in precious metals. The volatility is high enough without amplifying it artificially. The third mistake is ignoring opportunity cost. Every dollar invested in silver is a dollar not invested in something else. While you wait for the gold to silver ratio to compress, other assets might be generating returns. Stocks might be compounding. Bonds might be paying interest. Real estate might be appreciating. This does not mean you should avoid precious metals. It means you should think honestly about what you are giving up by holding them. The opportunity cost is real, even if it does not show up on any statement. The fourth mistake is failing to take profits. If the thesis proves correct and silver undergoes a significant repricing, you need a plan for what to do with your profits. Holding indefinitely is not a strategy. Neither is hoping for even higher prices after you have already achieved substantial gains. Decide in advance what circumstances would cause you to reduce your position. Perhaps it is a certain gold to silver ratio. Perhaps it is a certain percentage gain. Perhaps it is a certain level of media attention indicating that the trade has become crowded. Whatever your triggers, establish them now and commit to honoring them. The fifth mistake is allowing the position to dominate your mental bandwidth. If you check the silver price constantly, if you read precious metals commentary obsessively, if you argue with strangers on the internet about monetary policy, you have allowed an investment position to consume an unhealthy share of your attention. Investments should serve your life, not dominate it. Build a position you believe in, establish your rules for managing it, and then live your life. The market will do what it does whether you watch or not. The sixth mistake is confusing conviction with certainty. You can have strong conviction in a thesis while acknowledging substantial uncertainty about outcomes. In fact, this is the only intellectually honest stance in markets. No one knows the future. Anyone who speaks with certainty about market outcomes is either deceiving you or deceiving themselves. Conviction without certainty leads to sensible position sizing and risk management. Certainty leads to dangerous overconfidence. Cultivate the former and guard against the latter. Let us step back now from the specific analysis and consider what all of this means in the context of building long-term wealth and security. Precious metals are not the answer to every financial challenge. They do not generate income. They do not compound the way productive businesses compound. They have long periods of underperformance followed by shorter periods of outperformance. What they offer is something different. They offer a form of insurance against monetary disorder. They offer an asset that has maintained purchasing power across millennia, while countless fiat currencies have collapsed to worthlessness. They offer a store of value that does not depend on the promises of any government or corporation. This does not make them essential for everyone. A young person with high income, low expenses, and a long time horizon might reasonably decide that the opportunity cost of holding precious metals is too high, that their capital is better deployed in productive assets that compound over time. But for many people, some allocation to hard assets makes sense as part of a diversified approach to preserving and growing wealth. The question is not whether precious metals are good or bad in absolute terms. The question is what role they should play in your specific situation. The gold to silver ratio, if it does compress significantly, offers the possibility of outsized returns within the precious metals allocation. If you are going to hold hard assets anyway, thinking carefully about the relative value between gold and silver makes sense. But do not lose sight of the bigger picture while optimizing the details. A well-constructed overall financial plan matters more than the perfect precious metals allocation. A sustainable career matters more than the perfect entry point. Strong relationships, good health, meaningful work. These are the foundations upon which financial success rests. No investment, no matter how profitable, compensates for getting the fundamentals wrong. We have covered substantial ground together. We have examined the gold to silver ratio from historical, fundamental, psychological, and practical perspectives. We have discussed why some analysts believe a dramatic compression is possible, perhaps to levels not seen in modern markets. But let me be clear about what we have not done. We have not predicted the future. We have not guaranteed profits. We have not discovered a secret that will make you wealthy if only you act quickly enough. What we have done is think carefully about a set of possibilities. We have examined evidence. We have considered different scenarios. We have discussed how to approach these possibilities with discipline and rationality. This is all that anyone can honestly do when it comes to markets. The future is uncertain. Anyone who claims otherwise is selling something other than truth. What I hope you take away from this analysis is not a specific trade recommendation, but a framework for thinking. Markets move in cycles. Ratios that stretch to extremes eventually revert, often overshooting in the other direction. Supply and demand fundamentals matter over the long term, even when they seem disconnected from prices in the short term. If you choose to act on the analysis presented here, do so with patience, with appropriate position sizing, with clear rules for managing your holdings, and with humility about the limits of your knowledge. If you choose not to act, if you conclude that precious metals are not appropriate for your situation, or that the thesis is unconvincing, that is equally valid. The goal of this video was not to persuade you to buy silver. The goal was to help you think clearly about a significant development in the precious metals market. Whatever you decide, I encourage you to continue learning, continue questioning, continue developing your understanding of markets and economics. The greatest asset you can build is not a portfolio of metals or stocks or real estate. It is knowledge that allows you to navigate an uncertain world with confidence and clarity. The gold to silver ratio may be heading toward levels that seem unimaginable from today's vantage point, or it may remain elevated for years. The market will reveal the answer in its own time. Your job is not to know the answer in advance. Your job is to prepare for multiple scenarios, to position yourself sensibly, and to maintain the discipline to follow your plan regardless of what emotions the market provokes. This is how wealth is built and preserved over generations. Not through predictions that prove correct, but through preparation that proves sufficient regardless of which predictions come true. Thank you for your time and attention. The quality of your engagement with these ideas, your willingness to think carefully rather than react impulsively, is the foundation upon which sound financial decisions rest. Stay patient, stay disciplined, and remember that the goal is not to be right about any single trade, but to build a life of financial security and independence that can weather whatever storms the future may bring.